And let's look at the Kenyan economy now, as the Central Bank of Kenya hiked interest rates and the Kenyan shilling dropped to a new low against the dollar earlier this month. Let's talk to Matt Kindiger, practice leader, Sub-Saharan Africa Frontier View, to share his insights on this. Matt, what is your outlook on this situation for the shilling, given the slide in forex reserves?
Hi, well, thanks for having me on the program today. So in short, we are expecting more depreciation of the shilling over the next 3 to 6 months. And this is for a number of reasons. It's very clear that the central bank has been intervening into the FX market in Kenya, trying to limit the pace of depreciation of the shilling. And we expect this is happening for a couple of reasons. One is that it wants to contain inflationary effects from the cost of imports. It also wants to limit the debt servicing costs for the government's debt that is denominated in foreign currency. In our view, this is not sustainable, and this is because a relatively buoyant Kenyan economy is drawing in imports, which are very expensive because of high commodity prices at the moment. And we are also seeing an incredibly strong dollar and rising interest rates in the US and the Eurozone. And this will draw capital away from Kenya. So in our view, we are expecting to see the central bank relent to an extent, probably allow a more sudden or larger depreciation of the shilling at some point over the next few months. The shilling is likely to reach 135 or 140 per dollar by the end of next year. So certainly more depreciation to come.
But do you expect the central bank to continue raising interest rates over the coming months?
Essentially, yes. So we were previously expecting the central bank to limit the pace of interest rate increases, and this is because inflation was relatively contained in Kenya. But now we are expecting a slightly more aggressive set of interest rate increases. And this is because forex reserves, as you mentioned, are very low. And this is dwindling because of the dollar's strength and because of capital outflows. Inflation has also risen quite substantially and consistently over the last 10 months. It's risen every month, and it's now at about 10%, which is far above the central bank's target. And also, there are another couple of reasons. One is that the economy continues to grow relatively strongly, and so the central bank does have scope to raise interest rates without reducing the pace of economic growth substantially, and it can avoid a recession even if it increases interest rates. And finally, interest rates are actually relatively low in Kenya by recent historical standards. So they remain below pre-COVID levels. They're at just about 9%. So there is some scope again to raise interest rates.
Okay, so but given the foreign currency shortages that have emerged in recent months, Matt, can businesses expect to find any sort of relief?
Yeah, so this is actually something that most of our multinational clients operating in Kenya are concerned about. They've seen increasing foreign currency shortages emerge, and this is fairly novel for Kenya. It hasn't really been an issue over the last few years until recently. In short, yes, we would expect some improvement in access to foreign currency, and this is because, as we mentioned earlier, we are expecting some greater depreciation of the shilling. This will provide a bit of a relief for forex access, but the degree to which forex access improves really does depend on the pace of depreciation. And this depends on a number of factors, including what happens with the dollar globally, as well as investor sentiment towards Kenya. So, for example, if we see a deterioration in public finances that is worse than we're currently expecting over the next 3 to 6 months, you could see more capital outflows from Kenya, and this would aggravate foreign currency shortages. So certainly we would hope there to be an improvement in forex access. If not, then we could expect a very vibrant parallel market for foreign currency to emerge in Kenya, and this obviously causes some business planning problems. So yes, hopefully we'll see a bit more depreciation, and this will provide a bit of relief.
I just want to cast a view, towards for next year. If you just give me a brief outlook, taking into consideration everything you've mentioned now, does it look good for Kenya?
So Kenya's economy is actually relatively upbeat and relatively buoyant, and this is because despite the foreign currency shortages, despite rising inflation, we've actually seen a very rapid recovery from COVID-19. And also, if you look at GDP data for the first and the second quarters of 2022, we've seen a real acceleration in growth in services industries. And this is very good news for Kenya, because this means despite a very weak performance in the agriculture industry because of the drought, we are seeing non-agriculture, non-manufacturing industries do very well. Certainly, there is a risk when it comes to consumer sentiment, and credit growth. As interest rates rise, we could see more expensive credit, borrowing costs will increase, and as inflation increases, we could also see consumers temper their growth, their spending outlook. So certainly there are some risks on the horizon, but given the resilience of the economy, despite the war in Ukraine, despite what's happening with high commodity prices and shilling depreciation, we're still relatively upbeat for in terms of our view for the economy. We are expecting the economy to grow by between 4 and 5% in 2022 and 2023. So we're sort of cautiously optimistic.
Matt, we're going to keep that optimism going, especially for the African continent as it is. Thank you, Matt Kindiga, Practice Leader, Sub-Saharan Africa Frontier View, for joining us and sharing your perspectives on the program.
My pleasure. Enjoy your weekend.